Hi everyone, JJ here with The Art of Value. Welcome. Well, Steve Eisman, who 15 years ago was one of the very few people to see the housing bubble and profit from it back during the great financial crisis. Our value investing YouTuber friend Hamish Hodder has pointed out recently that Eisman's been on financial media lately talking about his prediction for the end of the stock market crash. Wouldn't that be good? Has it ended? Are we in a new bull market? Hamish also pointed out that Eisman's got a new area of focus that he's pretty interested in that's been a bit under the radar, so we'll talk about that as well. I'll respond to what Hamish said and to what Eisman said, so let's get into it. As Hamish pointed out, the S&P 500 index dropped about 25% from the peak, most of it being in 2022 last year, and then ticking up from about mid-October, and the Nasdaq index dropped way more than that. So what does Eisman have to say about that? Have we seen the end of that bear market? It's been consistently going up all of this year, and tech stocks have been on a bit of a tear, and of course AI stocks have been getting into an emerging bubble. I've made some videos about that recently, what different investors have been saying about that. Mohnish, Pabrai, Stanley, Druckenmiller, seeing it as already an emerging bubble. So we've gone from this deep bear market last year to a bubble in some areas. What does Eisman have to say about where he thinks the stock market is going, whether the bear market's over, and the investments he's involved in at the moment? Well, Eisman said if the Fed stops raising rates, he thinks there's no question that there'll be a significant rally in the stock market after that, and people will start focusing on what's going to happen in the economy. And of course, we've seen in recent days, inflation's been coming down. It came out at about 3% just in the last few days, and the stock market ripped somewhat since then. So will that continue? Is this the beginning of the bull market? And the stock market is forward looking, so it seems to be anticipating that the Fed might stop raising rates and even lower rates. Technology stocks have certainly benefited from this situation. Hamish points out that as interest rates have risen, it's reduced the attractiveness of stocks, their relative value compared to other investments, even cash. Because interest rates have risen, you can get higher rates on your cash even for virtually no risk compared to stocks. Eisman points out that the old paradigm of TINA, there is no alternative, has applied in the stock market for well over a decade. No alternative to the stock market to stocks because they've been more attractive compared to very low to no interest rates, but now that's changing. There are other investments with, say, 4.5% you can get interest rates on cash. So that's much more attractive, especially when the stock market's been in a bear market. So the relative attractiveness of other investments apart from the stock market has been rising since this new paradigm. Eisman's observed that even with his clients, that they can get 4.5% yield on pretty much no risk investments, and people think that's attractive. They're more interested in doing that than taking risks in the stock market. It's more of a thing than it has been for a very long time. Eisman said he's even been interested in doing this. He said he's been interested in buying bonds for the first time in about 15 years and also parking money in a money market fund at over 4%. He mentioned having short-term 3-month treasuries at 4.6%, which he says is pretty good compared to some of the things that have been happening in the stock market over the past year or so. So Hamish points out that if interest rates were to stop rising or even start going down for a period, that would be a strong catalyst for the stock market. And I could see that happening. It's very hard to predict what would happen even if as interest rates turn, but technology investors in particular would be happy about that. But you never know what's going to happen in the stock market. I remember Ray Dalio saying at one point in one of his interviews that he was so sure when he was young about this time when interest rates turned, and he was so sure that the market was going to go up, but it didn't. It did the exact opposite. So it's really hard to predict. I wouldn't be prepared to say that just because interest rates were turning that the stock market would have a huge rally, but it definitely could happen. I think the market is anticipating that already, and especially if you look at some of the tech stocks have been up over 100% this year. Spotify's up over 100%, Tesla's up well over 100%. Of course, Nvidia, many of these tech names are up over 100% in just the last 6 months. So Eisman acknowledges this could happen, that the stock market could ramp if interest rates started to drop or even stayed still for a while. He's skeptical of how long that would last. He thinks it could come down after that initial pump happened from the interest rate turn. And he thinks after that what would happen is that people would start to focus on what is actually happening in the economy. And if the data started to look bad, if there was a recession, a mild recession, if the data didn't look good, then the market might react to that also. As I said, it's very hard to predict what will happen, and I would not try predicting the macro. He feels confident to do so, I think, because he's been right before, but it's hard to be consistently right over time in predicting what happened in the macro. I think Hamish is correct when he says that the stock market is forward-looking about 6 to 12 months. It tries to look that far ahead, so it prices in expectation of what it thinks is going to happen. It's not a person, but collectively it does tend to look at events and look forward. So if some data comes out that's different from that, it could react either higher or lower. It does seem to happen like that. But it's a voting machine that way. It was Ben Graham who said that the market is sometimes a voting machine and then over time it's a weighing machine. So it's constantly voting on what's going to happen in the next 6 to 12 months. So Hamish says if the Fed chooses not to put interest rates up for a second month in a row, for instance, that would make the stock market go up. As I said, I think it's very hard to predict something like that. You think something's going to happen, as Ray Dalio and other great investors have said, you're absolutely sure something's going to happen and you could invest on that. Well, betting really, because it's gambling that the market could go in one direction or the other. A stock could go one direction or the other in the short term, and you can be wrong. It's very hard to be consistently be right. So I wouldn't be prepared to be that assertive about it. I mean, it seems likely, but anything can happen in the stock market. There can be so many events that dictate what happens in the short term. CNBC asked Eisman if he thought that the moderation of inflation recently made him feel better about what was going on. He says it does make him feel a little bit better, but it's only one data point. He does say that there's some evidence of a slowdown, but it's too early to tell if there's going to be a recession. He'd like to see more data, but he does see signs of that possibly happening. We've seen other investors say that there definitely is going to be a recession. Stan Druckenmiller has said there's going to be a deep recession, a hard landing, even though the data's changing on inflation. He's still been saying that recently. CNBC asked him if he would be willing to live with a 3% inflation figure. The Fed's trying to get it down to their 2% range, and Eisman said that he didn't think 3 would be that bad, and he thought it would be actually difficult to get it under that because of wages going up. He thought it would be hard to get it down to 2 again, but he'd be willing to live with 3, that would be okay. People thought it was going to be so sticky at one point that it wouldn't come down to where it is now. It seems to be coming down even % a month at the moment. So it's looking like 2 could be possible, but he's saying 3 would be okay. Could live with that. A lot of people were expecting for unemployment to tick up quite a lot, but it just hasn't done that yet. It remains to be seen. If there's a recession that could happen, that would be a sign that there is a recession, and that could affect the stock market as well. As I said, there are so many factors that can affect the market. When it's forward thinking, it can react to these data coming out. Eisman said that he thinks the Fed would be pleased to see unemployment going up and the rate of wage rises slowing because they're trying to slow things down. He'd like to see that. Nobody likes to see people out of a job, but in the terms of the overall economy, he thinks that the Fed would like to see that at this point. Eisman says that he thinks that Fed Chair Jay Powell is petrified of doing what Volcker did. What happened there when they stopped raising rates, they cut them a bit, and then inflation soared and they had to raise rates to 17% to actually get inflation down again, and that caused a recession. So he's petrified of not learning from that experience and that happening again. So they'll probably do too much and wait much longer before cutting rates and stopping cutting rates, he thinks. We'll have to see what happens. We don't know. Inflation seems to be coming down, but I don't think that they want to underdo it for that reason, for those historical reasons. So now let's turn to how Eisman is structuring his investments at the moment and this big opportunity that he sees that's a little bit under the radar. By the way, if you're watching on YouTube and getting value out of this episode so far, I'd really appreciate if you hit that like button to help with visibility. Thanks. Eisman thinks that the next period of investing will be characterized by risk-adjusted returns. Investors thinking about that again, and the interviewers question him saying, isn't that always the case with investors? And he says, no, the last period, more than 10 years, this last bull run, people have been rewarded for taking risk. If we think about the technology companies, profitless technology companies, early stage technology companies, getting heaps of funding for 0 interest rates, you could take a lot of risk as an investor. Things just kept going up. They seem to go up. There's been very little downtrends over the last decade or even more than that. But now he thinks we're entering a period where people will be considering a lot more, considering risk, and he wouldn't be investing so much in a technology portfolio. He says he's not so interested in that. So what is he interested in? He said he's more interested in diversification these days, not tech-heavy industries, more diversified across asset classes, across sectors, across currencies, across countries, just more diversified in general. He says he thinks this is the way to reduce risk over the next decade or so, to be more diversified across industries, because we don't know which industries are going to have headwinds, which ones are going to have tailwinds. He said it's very hard to predict that. As he said before, he's also interested in owning bonds for the first time in 15 years, and he sees that continuing. When Eisman was talking about particular sectors that he's interested in, he mentioned the US electrical grid, just how pathetic it was, and that not much has been invested in infrastructure, in US infrastructure for a very long time, especially the electrical grid. He mentioned how when he went overseas to places like Singapore and Asia, how great it was. He said that when you land at a new airport and you're going over new bridges and everything's just running smoothly, and then you come back to New York, to the US, and it's pretty depressing. JFK, you land there and go into the city and you notice the real difference, how not much has been spent on infrastructure. And he thinks that this is going to change. So he thinks a lot of money is going to be invested to get the US grid up to scratch, and that's a good place for investment. He mentioned one particular stock, one particular company in this area that he obviously owns, and that's Quanta. He said how it's been re-rated by the market. And if we look at the graph since 2020, it's up nearly 400%. So yes, I think we could call that a re-rating, 400% since 2020. And notice how it didn't really get hit by the downturn, by that bear market last year. It's just been going up since 2020, a huge re-rating for that company, and there's a reason for that. He says, for example, in California, the utility PCG is putting all of its wires underground, and he says that Quanta is involved in doing that. So that's a huge amount of wires, and he said that could be happening in more places. And that's one of the reasons for the re-rating of this company, that people can see this electricity infrastructure needs a lot of work and it's going to get funding. It could be more of it over time. He's obviously pretty bullish on the grid in the US, the improving, the upgrading of the grid. And of course, with renewables, he didn't mention this, but with renewables, there needs to be a new grid, something that works more like the internet, a multi-way, not just a one-way transmission, to take account of all these intermittent resources, improving of the grid, and modernization of the grid to contemporary infrastructure. Do you have any companies in this area, in the grid infrastructure or infrastructure in general? Are you looking at companies? Are you invested there? Let me know in the comments. I'd love to know your thoughts on that area in particular. Also, I'm going to put a video up here, a previous one about Steve Eisman that I did a few months ago, to see how his thoughts have changed since then. It's interesting to see what he said back then. And up here, I'm going to put a video on YouTube of what YouTube thinks that you should watch next. So go and see either one of those. And I'll see you next time. Thanks for watching or listening.